What exactly is inheritance tax planning? You hear these words banding around on the internet, just buzzwords at the moment, especially after the recent budget. At the time of recording this video, I want to just take some time out just to go over what the basics are of inheritance tax planning. So I'm going to break it down into different stages. So the first thing really is to find out, before we can talk about planning of inheritance tax, what exactly is inheritance tax? So excuse my doctor's handwriting and my wonderful trusted chalkboard. But what is inheritance tax? So inheritance tax is literally a tax that's levied on the transfer of wealth, okay, particularly when a death event takes place. So that means that potentially anyone who passes away could be subject to paying inheritance tax on their estate, which leads me to the next point. Well, what exactly is an estate, in case you're not sure? Because a lot of people are not sure how to. We do have a quiz on our website, which is oncewillsandtrust.com. I'll leave that in the comments below if you want to check it out. But an estate literally is just all of your assets and your possessions, okay, that you own in your name. And if you were to add that all up, it reaches a certain value. Once that value is exceeded, then the difference will be subject to the 40% tax. Can you believe it? 40% is the inheritance tax banned at the moment. So it's really, really quite expensive, a lot of money. And most people pay a lot of taxes during a lifetime. So surely you want to know to pass that wealth onto your family, ideally free of any inheritance tax. So an example of your assets would be, you could be your main home that you live in. Okay. Obviously, house prices vary up and down the country, so I'll just use an average, say, £500,000. Then you could be your personal assets. All right, and all this is done during a process called probate, how it's calculated. All right, let's call that, I don't know, £50,000. And then you've got savings, that could be £20,000. And you've got investment property, potentially. All right, let's say it's £1 million. And then you've got life insurance policies, etc., etc. So all this, when you add it all up, is classed as your estate, the value of your estate. Now, if your estate value exceeds, okay, is actually greater than this magic number, at the moment, at the time of recording this video, is £325,000, and we call that a nil rate band, okay? And this rate is now frozen, this threshold is now frozen until 2030, it won't be reviewed. So if your wealth exceeds this value, then the difference, or the excess, all right, will be subject to a 40% tax. So if I have an estate value, okay, an example here, if I have an estate value of £500,000, let's keep it really simple, as an individual, and then I deduct this £325,000 value, the difference is £175,000, and then that, subject to 40%, if someone passed away, would give me an inheritance tax potential liability. All right. So, and then that's a lot of money. And then the question is, well, how do you find the money to pay that off? And then we get into other questions and complications. So it's really important now. Now you understand the basics of what inheritance tax is and how it's calculated, that planning is really a lifelong a requirement, okay, especially if you know your assets and your wealth is exceeding over time. The house value of your home is increasing. If you are a property investor and you accumulate more, that's obviously your estate is increasing. If you have a life insurance policy, a death in service policy with your employer, your value of your estate is increasing. As your family dynamics change, you're having children, get married, get divorced, own businesses, invest in stocks and shares, etc., etc., your wealth will just start to move and change and ideally start to increase. So a lot of us look to earn more money as an income, pay less income tax. If those with financial advisors will be looking to increase their wealth over time, okay, so that their wealth is worth more than the inflation. So you're increasing in wealth, but no one really talks about, well, what happens at the end? What's the exit plan? And if you're a business owner, we work really, really hard to provide for our family and loved ones so that they have a good head start in life. And then, oh, hang on a minute, if I don't plan properly, then there's one thing, them getting divorced and remarried and that money's going sideways. But if I pass away, then that's 40% going to be a tax on that wealth as well. And then the other really quite dire situation is if you pass all that wealth on to your children and they don't do any planning, then they're going to get taxed again on the same wealth that you got taxed on the first time around, a generational inheritance tax. So planning is absolutely vital. Okay, so the benefits is basically to save money in terms of your wealth. Okay, in terms of family dynamics, keeping the peace so that no one's disinherited unnecessarily, that your plans are actually carried through. Okay, how you want it to be done, as opposed to completely opposite to what you expected. Most lawyers don't really understand inheritance tax, so they don't talk about it much. You need to be in front of someone who can help you and make sure you make the right decisions and choices going forward. Okay, so that's really all I wanted to do, introduce the topic to you, understanding why inheritance tax planning is absolutely vital. There's a lot more to it than just what I've said here, but at least it kind of gets the wheels going in your mind, allow you to ask more questions, and ultimately dig a bit deeper to find out how you could potentially put yourself in a position to pay as little or no tax whatsoever because you got the planning done earlier rather than later. All right, so that's it from me. I'll see you in the next video. Cheers.